Hello and welcome to our latest Insider interview. Today in the studio I have with me Henry Dixon, Fund Manager of the Man GLG Income Fund. Henry, thanks for your time today.
Thank you for having me.
So Henry, to start off with, could you explain how you invest and what the fund is seeking to achieve?
Yeah, absolutely. So if we start with the objective of the fund, we're certainly aware of the need to beat the All-Share Index over a period of time. But I also think crucially provide a yield well in excess of the All-Share. And I think the yield point is important. And actually I think what maybe sets the fund slightly differently to other funds is the monthly dividend, which I think has been very well received from the investor base. If I think how we go about trying to do that, I would sort of highlight three types of opportunities that we look to invest in. First is businesses below replacement cost. Invariably that can be quite a contrarian portion of the market, but you're looking for lots of asset value, definitely a sector that will probably be out of favour at the time when you take the investment. But if you can line it up with good balance sheet and cash flows that certainly sort of can weather the storm and the cycle can turn, that can actually be a very rewarding part of the portfolio. A second element of the fund is where we see returns on capital that are just mispriced relative to the capital base and the market cap. And then finally, we like to have a portion of the portfolio where we have free cash flow yield above the market average, a net cash balance sheet. And that can typically drive quite attractive dividend growth, which can hopefully also be well rewarded with regards to capital upside.
So for those three areas of the portfolio that you mentioned, could you name a stock example for each?
Yeah, absolutely. So let's think about below replacement cost, a recent addition, but we think about a company called Anglo-American, a mining company. Shares have been quite weak now, but for the prevailing price relative to their asset base, there's really absolutely no chance of replicating that asset base for the current price on the screen. Why is it here and below that asset base? Well, it's clearly concerns around China, how that's playing out. But with the shares now down about 30% this year, that for us looked like a really good opportunity to be taking advantage of. If I think about shares where there is returns, healthy returns on capital that aren't being priced appropriately by the market, I might come on something like HSBC. Big constituent in the market for sure, but there was a very important catalyst last year with regards to the sale of their Canadian operations. So they managed to sell a very decent portion of their business for well above book value, but the business in aggregate was trading below asset value, and you had a clear catalyst for that excess capital to be returned to shareholders. That was also quite an important decision last year, and I think ultimately a very profitable one. And then finally, I might also think about a business with lots of cash on balance sheet, the opportunity for dividend growth. It's a business called Centrica. It's had a very tough decade indeed, but I think what we saw last year was the competitive landscape be transformed quite materially. The balance sheet became net cash. They returned to the dividend list, and the valuation incredibly modest. Still in many ways sort of perceptions suffering from the scar tissue of the last decade, sort of 3-4 times earnings. So we had a really good combination of earnings momentum, very low valuation, and a very strong balance sheet.
The fund has a dividend yield of over 5%, which is higher than most of your peers in the UK equity income sector. So in order to achieve that yield, how do you strike an appropriate balance between looking for high income and then also looking for capital growth as well?
Yeah, absolutely. I think it's a really important question because, as I think high income is not enough. High and static income certainly is not enough. And I think events of the last 2 years have proved that with the return of interest rates. So what I'd say is that in every instance, we absolutely don't neglect the importance of capital growth in every investment decision that we make. I think that's absolutely vital, and I think a very good way of trying to grow income over a period of time is clearly to try to do it with more capital. So I think that brings the capital growth element into it very importantly. The other aspect I think with regards to dividend growth is very important that you operate under a proviso of conservative balance sheets, but also an environment whereby free cash flow yields are in excess of a dividend yield. So you have that headroom in which to grow. And I think if you can marry up those two elements of value and then also within that excess free cash flow that allows dividend growth, then I think you have a really good chance of growing capital and income through the cycle.
And could you name a couple of the highest yielding stocks in the fund today that presumably you think the dividends are sustainable going forward?
Yeah, absolutely. I'll probably give you 2 or 3 because I And invariably, when stocks attract a high income, there's a feeling about risk of being cut, and you've got to try to sort of traverse that line of high yields that aren't cut, absolutely. But if I was to give you 2 or 3 examples of companies with a high yield in the fund, I guess one of the highest yielding within the fund is onshore gas company in America called Diversified Energy. We actually partake in the IPO in 2017, and the shares have slightly more than doubled since then. And actually, the income from that company has probably risen about fourfold in the 6 years they've been listed. So it's very good dividend growth. But today it's on a dividend yield of 15. So clearly question marks emerging around sustainability of it. And certainly it's a business model that has relied on debt. And clearly we now have higher interest rates. So how do we feel about the risk to dividend in a higher interest rate environment? Well, I'd say 2 things. I'd say firstly, the company's done quite well with regards to terming out its terming out its debt profile. I think that's absolutely important. And then also they very much hedge their operations and de-risk their operations. And what I mean by that is they've got very good visibility on the gas price for the next 2 years, and they've also got a very low operating cost base. Being onshore in a place like America means you're probably one of the most competitive producers of gas anywhere in the world. So I think that gives us confidence there. Another areas of high yield at the moment would certainly be banks. It's a very emotive subject at the moment, but I think they've corrected a lot of the issues probably with business models we saw 15 years ago. But it's quite difficult to get double-digit yields out of banks at the moment, a combination of dividends, also buybacks, but I'd highlight HSBC, that's also going to give a special dividend to investors in the wake of the sale of their operation last year. And then finally, probably, again, a business that I think investors might know quite well, but, Imperial Brands, that will be a yield best part of 9%, also complemented by a buyback. So again, we're looking at total returns of over 10%. But certainly if I look at Imperial Brands, we don't own the other tobacco share in the market at the moment, British American Tobacco. The reason we prefer Imperial Brands is a better free cash flow yield, better working capital management now, and actually a much better valuation, and also critically a much better balance sheet. So I think it's that excess free cash flow yield, sector leading balance sheet that gives us confidence there. But you're absolutely right to push on these high yield shares, because these are the areas of the biggest reward and clearly some of the biggest risk.
And when you're assessing the sustainability of a dividend, when there's a high yielding share, how are you avoiding the potential value traps? Are there any red flags that you look out for?
Yeah, absolutely. Value traps are just, such a painful part of the job, and you do everything you can to insulate yourself from that. I think maybe if we look at probably a couple of the value traps of the last year in the market, we managed not to own them, but I would let's look at something like Vodafone, cut the dividend, it's a weak share price. I think, again, another sort of dividend stalwart was deemed to be, would have been car insurer like Direct Line, again, cut the dividend actually to zero. So, these are very damaging events and you try and sort of work out a common theme of value traps and what happens. I mean, definitely I would observe that, financial leverage can certainly get in the way of realising the value that might be on offer. So if you look at something like Direct Line and compare it against another competitor, Admiral in the space, Admiral, a miles better balance sheet, hasn't cut the dividend in the way that Direct Line has. So it's that dividend element that I think is important. And also, again, if I look at something like Vodafone, further to high starting leverage, you have quite a bit of capital intensity. So I think it's really important you think about cash flow trends. So there's clearly, desire to invest, requirement to invest, that can be very expensive, and also working capital trends that can sort of, really sort of obscure cash flows. So I think those would be 2 really important elements that we try to screen out. And then the other thing I also think with regards to value traps is just think about structural threat. And there might be parts of media at the moment that are certainly facing some quite structural pressures. And typically structural pressures will require companies to invest. And again, I think it's that level of investment that can obscure the cash flow. You can suddenly see a huge mismatch between cash earnings and stated earnings. So I might highlight something like ITV, for example, which has definitely sort of fallen into that trap of being viewed as a value trap. But if you look at the mismatch of cash earnings versus stated earnings, then I think that the story is quite clear.
You mentioned earlier, the fund, it pays a monthly dividend, which sets it apart from competitors. Does that make it harder to manage the fund? Do you have to take into account when dividends are being paid throughout the year in order to have a certain amount of income come in each month?
Certainly. So, we do a lot of dividend analysis on timing, quantum when it comes in. Although I think the key thing that encouraged us to make the decision to move to monthly was actually the year end of the fund. So the year end is February. And because it's a unit trust, not an investment trust, you have to pay out all income in year, although you can smooth the income flow within the year. But if you look at the cycle of dividends from the market, it's very definitely the sort of, very rich part of dividend collection happens in March and April. So despite the fact we hit the ground running with no dividends in the tank on March the 1st, it's those months of March and April that allow us to accumulate quite a bit of income. And what we like to do for our investors is provide them with a forecast for the flat payments they're going to get throughout the year, and typically they get a little bit more at the end of the year. So I'd say it's a combination, I'd say, of the luck, I think, of, maybe the February year end, but also just in general the value on offer from the UK market, which is one of the high yielding markets globally.
Henry, thanks for coming in today.
Thank you, Carl.
That's all we have time for today. You can check out the rest of our insider interviews on our YouTube channel, where you can like and subscribe. Hopefully, see you next time.